Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letters CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Market volatility and your retirement. Creating a buffer with reverse mortgages. That's what we're going to be talking about today on Reverse Mortgage Radio. Glad you could join me today. Here we are. We just had Halloween. We're days away from a major election. We have all kinds of stuff on the ballot. Hopefully you've got your ballot in. I'm going to be taking care of mine this weekend. I'm not one of those that got it done early. But how is that all going to affect the market? The real estate market, the stock market, the bond market? Who knows? Because last we heard, the Federal Reserve lowered interest rates, right? But ever since they lowered rates in the middle of September, I think it was, the long-term rates have been increasing. I don't know if you know this, but they've gone up 0.75 of a point in the last month and a half, 2 months. What does all this mean? I don't know. I'm not a financial advisor or a stock market guru. I'm just a lowly old reverse mortgage salesman. And we don't know what's going to happen down the road. Although I kind of see some volatility one way or another. I don't think the real estate market is going to be dropping. I really don't. There's people who do predict that, and I don't think that's going to happen. But I'm not a prognosticator. I really don't know. But I do know one thing. It's good to have a reserve account, a buffer, and it's also good to keep your debt load to a minimum. And a reverse mortgage can help you with both of those. So I'm very glad you're here with me today. We're going to be talking about all kinds of market volatility and how reverse mortgages might, I stress the word might, be able to help you out with that. My name is Bruce Simmons. My direct line, if you have any questions about reverse mortgages, my phone number is 303-467-7821. That's my direct line. You can reach me at that number. I've been doing reverse mortgages since 2003, and I've actually had that same phone number, since 1999. It rings to an office that I have in my house. It's a landline. Do not text me at that number. I won't get it. But that I do have that forwarded to my cell phone. So you can always reach me at that number. Leave me a voicemail if I'm unavailable. You can also visit me online at reversemortgageradio.net. Reversemortgageradio.net is my website. Go there and download my free consumer guide. It tells you all about reverse mortgages, probably more than what you want to know, honestly, about reverse mortgages. It may create more questions than you have now. And that's great because you can just call me after you've taken a look at that, absorbed it, give me a call. I can work up a quote for you, or you can also even get a quote on my website at reversemortgageradio.net. So today we're going to be talking about market volatility, your retirement, and how a reverse mortgage might be able to create a buffer for you. Okay, so I'm glad you're here. Let's talk about market volatility. What is market volatility? Basically, it's when we don't know. There's always volatility, right? But is volatility the stock market dropping by 100 points? And by stock market, I mean the combination of the Dow Industrial, the NASDAQ, and the S&P 500. If they drop by 100 points, is that, or go up by 100 points? That's not really volatility these days. It was back in the day when the stock market, when the Dow was at 8,000 or 3,000 and it dropped by 500 points in 87. Well, that's a huge adjustment. And in fact, let's real quick just go over a few of these volatile times that we had. Back at Black Monday, that's what I was talking about, on 19th of October, 1987. The infamous stock market crash, that's the way they put it on Google, it represented the greatest one-day percentage decline in stock market history. And it culminated in a bear market after a more than 20% plunge in the S&P 500 and Dow, the Dow Industrial Average. And that caused all kinds of chaos. Now, at that time in 1987, I had just gotten out of the Army. I had no money in the stock market. I remember it happening because I remember my dad was big in investing. And I thought, oh no, what's that going to do to him and his retirement? But he seemed to weather it okay, bounce back. And then in the early 90s, July of 1990, when Iraq invaded Kuwait, it caused oil prices to spike, and the Dow Jones Industrial Average dropped 18%, in 3 months. It went from 2,900 down to 2,300 or 2,400, and it caused all kinds of problems. And then in 2000, from March 10th of 2000 to October of 2002, about 2.5 years, the market dropped 78%, beginning with the dot-com bubble. And then there was September 11 in there. And then there was a downturn in prices in 2002 on all the stock exchanges. I mean, it hit United States, Canada, Asia, Europe, everywhere. And it caused all kinds of problems. Imagine if you were trying to retire. I remember actually doing a loan for a lady in 2003, one of the first loans that I did when I got into this business, when I used to work for the Evil Empire, the company with the stagecoach. I remember this lady, she wanted to retire. She was planning to retire, and she was still working in 2003 because of that downturn, the dot-com bust. And we paid off her mortgage for her with a reverse mortgage. And I remember she cried at the closing, not because she was happy. She cried because she was, quote unquote, I'm doing the air quote thing, selling her home to the bank. And back then we offered a lot more money than we do today. In her mind, she was giving up control of her house. Now it's kind of funny because after, after the 2008 drop in the values, she was good and she was receiving income for a while because we were sending her monthly payments as well as paying off her mortgage. She was able to stop her monthly payments like in 2010 or 11, and she was so happy about that. And she told me how she was embarrassed about crying after the closing, and because the reverse mortgage really saved her life. That's her word. She said it saved her life because of it. It helped her retire and eventually have peace of mind. She didn't have peace of mind at first, but she did because she realized it. And then, of course, we all remember the 2008 debacle, which was really the only time where the combination of the stock market and the real estate market both really crashed. That they were huge crashes in both. And I did a lot of business in 2008, 9, and 10 because people were so worried about their money, their lasting, because they had so much money in different stock markets or in real estate even too. Now, some people were positioned to take advantage of it. I think I've mentioned before, a guy that lived in Golden, we did a reverse mortgage for him, and he was a contractor. He was retired, but he was saying, hey, I can't miss out on this because he started buying up condos with money from the reverse mortgage line of credit. He'd buy a condo, fix it up, sell it at a big profit, and then he'd turn around and pay down the reverse mortgage. And he did that a few times at least. I don't know because I didn't stay in touch with him exactly how well it panned out. But that was his plan, and I know he did it some. And I don't know if he converted any into rentals or what happened with him because that was, 15 years ago. But anyways, and then also, too, there was a flash crash. This could affect people's retirement a lot. In 2010, May of 2010, the Dow Jones suffered its worst intraday point loss, dropping 1,000 points. It partially recovered later in the day. That's volatility. Okay, that's what I would define as volatility for you. And it goes on and on. In 2015, there was a stock market sell-off. In 2018, 2020, 2022, the S&P peaked at 4,700 on January 3rd, and then it closed down 18% by November, or 33%, I'm sorry. The NASDAQ actually fell 33% by November. So you could see how that was just in 2022. Imagine if you're trying to retire, you're planning for this money to be there, because basically the savings that you're working so hard for while you're working and investing, that's what it spins off the interest or the earnings, and that's what you're supposed to use in your retirement, and you leave the principal alone. That's the goal, again, quote unquote, air quotes here. So how often can that happen? Or does happen for people? I don't know. I'm hoping it happens for me that way, but we'll see. I'm worried about it, and I've said before, I know for a fact I've got a financial planner, and I've told her that this is my plan. A reverse mortgage is part of my plan for my for my retirement. I know it can benefit me in retirement. Let's talk real quick too about traditional strategies that people have. I mentioned, saving and then turning around and living off of those savings without touching the principal. That's the goal, the 4% rule, if you will. But, you've got to diversify asset allocation. Now, a lot of financial advisors will say, oh, you got to do the 60-40 split, the 60% stock or 60% bonds, depending on your age and things of that nature, and the opposite of bonds or stocks. Just depends on your age and things of that nature, because bonds traditionally are supposed to be safe. Well, if you invested in bonds over the last few years, you're losing your shirt if you have to sell them today, because as interest rates go up, the value of bonds goes down. Think about it. If you have a bond paying 1% or 2%, a 10-year bond right now, that thing's worth 70% what it was when you bought it, because now interest rates are at 5% or 6% or 7%. And if you could get a bond at 5% or 6%, why would you get one at 2%? If I had to sell that money, if I had to liquidate that bond today, I would be taking a bath. In the meantime, I could keep it to maturity, but I'm losing money to inflation. Same thing. So bonds are not safe like people say. Keep that in mind. There's also something called the bucket strategy. This is where you manage volatility by dividing your investments into separate buckets based on their time horizon, with each bucket holding assets appropriate for a certain time frame. They allow you to access necessary funds without selling investments during market downturns, but you still maintain growth potential on the longer-term buckets. Essentially, it's a way that you can segregate your money, if you will, to meet different needs at different times. You mitigate the risk by prioritizing liquidity for short-term needs and allowing for higher risk investments for long-term goals, because you've got time. If it's a 10-year investment, you've got time to recover if that investment drops by 10%. Hopefully it wouldn't, but hopefully it doesn't drop by more. But there's always that risk. And so like you could have an immediate bucket that covers 1 to 2 years of living expenses and a combination of money markets and CDs and cash. Intermediate buckets, they might be a short-term mix of bonds or safe, if you will, equities. Could be income-producing things like Exxon or something like that, the big companies that spin off dividends. And then the long-term buckets are for growth. And then you've got to make sure to maintain that balance. And I'm not an advisor, okay? I am not giving advice. I don't take advice from me. I'm lousy at that. I've lost more money than I've saved so far. So certainly don't take any ideas from me. But these are the ideas that people have. Well, what if you had a line of credit with a reverse mortgage? You had money set aside that's guaranteed to grow over time without having any risk at all. And it's going to grow regardless of the value of your home, regardless of if the stock market goes up or down, regardless of if real estate goes up or down, regardless of interest rates. It's going to grow, period. If you had that money available, you had an extra $100,000 there, and you had that for the immediate liquidity needs. Or, well, I'm not going to get into that yet. We're going to talk about other different ways that you can use a reverse mortgage. Let's explain what a reverse mortgage is first, though. In a nutshell, a reverse mortgage is most often an FHA-insured loan that's specifically designed for people who are 62 and over. There are non-FHA-insured loans that don't have quite as many benefits, but they're still good products for people down to age 55. Okay, they're not FHA insured. The line of credit isn't as good. The different options are not as available as they are with the FHA program, but they're still good programs. But essentially, it's intended for people to convert a portion of the value of your home into cash that you can have access to without obligating yourself to a monthly mortgage payment. Now, the house stays in your name. It's still your house, so you must do 5 things. You have to do these 5 things to keep this loan in place. You have to live there as your primary residence, only available for a primary property. You can't use it to buy, or you cannot get a reverse mortgage on an investment property. You have to pay your property taxes, pay your homeowner's insurance, and you have to pay those on time, and any other maintenance on the home. You have to maintain the home, so keep it up and current. You have to keep your name on title, okay? So you have to do those 5 things, and as long as you do those 5 things, you never, ever, ever have to worry about making a payment. However, you are still charged interest. Well, wait a minute, Bruce. If you're charged interest, where does that interest go if I'm not paying it? Good question. You're a smart cookie. What happens is that interest gets added to the loan balance. It's called negative amortization. You know, you've seen those amortization schedules where you make your first payment on a 30-year mortgage. It's a $1,500 payment, and about $1,490 goes to interest and $10 goes to principal. And over time, eventually you get to where most of it's going to principal. If you pay on it for the next 25 years, then most of it's going to principal. This is in reverse. Basically, you're charged interest every month, so that interest gets added to your loan balance. Your loan balance gets bigger and bigger and bigger over time. And please understand this. When I meet with people, I explain the amortization schedule in detail. You have to be okay with this, because what happens is every month you're going to get a statement, and you're going to see that loan balance getting bigger and bigger and bigger if you don't make payments. You certainly can make payments if you want. There's never a prepayment penalty on any reverse mortgage, whether it's FHA or not. There's no prepayment penalties. You can pay as much or as little as you want, or none, which most people don't pay anything. But that loan balance gets bigger and bigger and bigger. 10 years from now, if you take out $200 today, you might owe $400, or you might owe $100, or owe $350 or $400, whatever it might be. 20 years, you might owe $500, $800, whatever. I don't know. It depends on interest rates and how, if you do make payments, how you use line of credit, all kinds of different things. But the loan balance is going to go up. However, remember, you're saving that principal and interest payment every month. If that payment's $1,000 a month, you've got $12,000 every year extra in your pocket that you can invest, you can save, you can use to pay off other debt, or you can use to increase your standard of living. You can help relatives, all these things that you could do with that extra money. Plus, your value of your home, odds are, is increasing. There's going to be years where it stays static or even goes down like it did hopefully not like in 2008, but it might drop by 2% or 4% 1 or 2 or 3 years in a row. And then it's going to go back growing by 4% or 5% or 10% or 12% like it was for so long in the 2020s and early the 20-teens. It was growing by 8-10% every year. So the value of your home is going up. If you owe $400,000 10 years from now on that $200,000 reverse mortgage, the value of your home might go from $500 to $700 or $800. And now you owe $400 on an $800,000 home instead of $200 on a $500,000 home. So keep all those in mind. By the way, if you just tuned in, you are listening to Reverse Mortgage Radio. My name is Bruce Simmons. I'm the Reverse Mortgage Manager with American Liberty Mortgage. Give me a call with any questions about anything you've heard today or anything about reverse mortgages at 303-467-7821. 303-467-7821. That's my direct line. And you can also visit me online at reversemortgageradio.net. Go there. You can get a free quote right there at that time or you can download my consumer guide. Do both. Heck, whatever. It's at reversemortgageradio.net. If you did just tune in or you have to leave, go there. You can download or listen to the podcast as well on my website. And it'll be up there usually like by Tuesday. I think it's up there most often. So I'd be glad if you went there and listened to me there too. So let's talk about ways that a reverse mortgage might be able to help you. Okay, because the thing is, there's a number of different ways. Reverse mortgages are incredibly flexible. A lot of people, way too many people in retirement, think they can retire with a mortgage payment. And it makes it just compounds things. It makes it a lot more difficult because you're spending more money every month. And you don't have that extra money every month coming in from a job. So you're draining your savings quicker, unless you happen to have a great para plan or a great Social Security plan that easily covers your mortgage payment. But even then, if that's the case, why make a mortgage payment? Why not pay off your mortgage with a reverse mortgage so you don't have to make a mortgage payment? Save yourself the principal and interest portion of that payment. Of course, you still have to pay the taxes and insurance, maintain your home and all that stuff. But you save that money then and keep it, because cash flow is king and you just don't know what's going to happen down the road. I have some people tell me, well, maybe I'll wait until I need it. That's not a good plan, because when you need it, sometimes it might not be available. I mean, people in 2009 or 10 who needed a reverse mortgage, they might have owed too much money at that point because the value of their home dropped, and I couldn't help them. That reminds, just in 2022, when rates started going up, the percentage of money I could loan to people started dropping. As interest rates go up, the amount of money I can loan as a percentage of the value of your home goes down, because FHA tells us, they dictate to us, the lender, how much money we can loan. It's based on the age of the youngest homeowner. The older you are, the better. The value of your home, obviously, the higher, the better. And the interest rate, the higher the interest rate, the less money I can loan you, okay, as a percentage of the value. When rates are low, you're older, and the value is high, hey, you get the maximum amount. That's perfect. That's 2020 and 2021. 22, rates started going up. Property values still hung in there. They were still doing okay. But as interest rates went up, I could still, like, people would call me, we could pay off their mortgage, but instead of getting $100,000 left over, maybe they only had 50. And people were like, well, the interest rates are supposed to come down in 2023. That didn't happen. They went up a lot. And what happened? People call me back in 2023, early 2024. I can't even loan them enough to pay off their mortgage now. So they're still stuck, paying their mortgage payment when they could have had the last 2.5 years or 2 years without a mortgage payment. So waiting until you need it. Now, if somebody needed it at that time, now they're out of luck, right? Because I cannot do it for them. And it just creates all kinds of problems. So get it in place now. Pay off your mortgage if you qualify. And if there's $10,000 left over and you leave it in a line of credit, well, maybe that'll grow. Remember, I said the line of credit grows. It could grow to be $12,000, $15,000, $20,000 down the road, 2, 5, 10 years down the road. Okay. So remember, that's a guaranteed growth rate on that line of credit. Even if I can't give you enough to have money left over in a line of credit, but we can eliminate your mortgage payment, then you can save that extra money and create your own buffer account, if you will. But having that line of credit also allows you to access money if the stock market goes down. Let's say you've got savings it's invested in the market. Okay, it's at risk is what people call it. If it can lose, it's at risk. Whatever the risk level is, it's at risk. If that happens and you need the money, you're locking in your losses if you do that. If the stock market drops by 5% and you need that money, well, now you just lost 5%. It could bounce back and grow by 10 or 20% a year from now, but you're not going to see that if you have to pull your money out now at a 5% loss. Why not have it available with a line of credit? The other thing is a lot of people are pulling money out every month for living expenses from their investments. Why not take it from, and they're paying taxes on it too, where if you take it from a reverse mortgage, you're not taxed. It's loan proceeds. Now, if you take that money and invest it in something, then you could be taxed on any gains, but the reverse mortgage proceeds themselves are not taxed. So you take that money out on a monthly basis. We can arrange to pay you on a monthly basis. We can also, let's say you've got credit card debt. Holy cow. If you're doing that, you're paying 23, 24, 27, 30% interest. Why? If you can get money from a reverse mortgage and pay that off, that could save you hundreds or thousands of dollars every month. Keep that in mind too. And so there's all these different ways. You could do a combination. Let's say we give you $1,000 a month and we leave $50,000 in a line of credit for emergencies. And give you $20,000 to pay off credit card debt. I mean, depending on how much equity you have in your house and how old you are and things of that nature, we may only be able to pay off just enough to pay off your mortgage. But if you own your home free and clear, maybe that might be a great way to do it. So you got to keep that in mind. The flexibility, too, of changing things. If your financial situation improves, you get a part-time job, or you're a consultant and you land a big contract. Now you could pay $20,000 towards a line of credit to lower your loan balance. And that money gets then moved into the line of credit. So if let's say you take out a reverse mortgage and you borrow $200,000 to pay off your mortgage. And 6 months from now, you get this big contract, or you're a realtor, let's say, and you have a great month. You close 3 loans, 3 houses, and you make $40,000. Well, now you can take that money, put it towards your loan balance, reduce your loan balance by $40,000, but that $40,000 doesn't just disappear in equity in your house like a fixed rate traditional mortgage. It moves over to your line of credit and you still have access to it. There's so many ways that you can benefit with a reverse mortgage, combining it with other financial plans. I love talking with financial advisors and explaining how reverse mortgages work and all the possibilities. They know a whole lot more than I do about how a reverse mortgage can really benefit you once they understand how a reverse mortgage works. And so I would be very happy if you have a financial advisor, you want me to talk to them, and maybe you don't do a reverse mortgage, but at least then you're looking at the possibilities of it and you're making an informed decision. You're gathering information and you make an informed decision. Okay, it's not for me now for some reason. Honestly, I think it's for everybody. In my mind, I really do. I'm going to do it and I don't need it. I know I've still got a few years to go, but I certainly am going to do it when I'm in a house that I want to stay in and I'm old enough. But anyways, give me a call. I'd love to talk with you, answer whatever questions you have about reverse mortgages. 303-467-7821 is my direct line. I'd be happy to talk with you, or you can visit my website at reversemortgageradio.net. Again, and download my consumer guide, get a free quote, whatever the case may. Listen to the podcast. If you just tuned in, you missed it, but you can still get it next week on my website at reversemortgageradio.net. reversemortgageradio.net, or simply give me a call at 303-467-7821. My name is Bruce Simmons. I'm the reverse mortgage manager of American Liberty Mortgage. And thank you so much for listening to Reverse Mortgage Radio. Hope you have a fantastic day. And I don't know what's going to happen with the election.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821, or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.